The past 12 months have been such a wild ride. There's been so many changes happening in such a short amount of time. So in this video, I'm going to give you 2 things that you can do to prepare in the new year so that you feel good about your retirement plan and your investment plan. And if you're thinking about retirement, you'll find some helpful links in the description below, so be sure to check those out. Well, the first thing to do in the new year is review your asset allocation. Since there were so many extreme swings last year in the markets, and maybe your portfolio, it may make sense to sit down and just review how your money is allocated. Meaning, what's the mix between stocks and bonds and maybe some other asset categories that you might own? It's important to do this because if you don't, you run the risk of becoming more and more aggressive the older that you get. And that might be exactly the opposite of what you want to be doing. And here's an example. I'll share my screen and take a look at this is a made up portfolio, just to keep it simple, of stocks and bonds. So here's the stock portion 60% and then the bond portion 40%. If over time the stock portion did go up, then you'd see something eventually where they take up a bigger piece of the pie. So maybe 75% to 25%. And if you do nothing and don't review the allocation and see what you're doing, then you run the risk of that stock portion taking up a bigger and bigger piece of the pie each year. If you're projecting your income based off your investment balances, then you could wind up in hot water if there's a big correction or something that was just unexpected that affects stocks more than they affect bonds. That could really move the value of your portfolio in a pretty drastic way. And something we'll do for our clients who are in retirement and value more predictability and less surprises is to regularly rebalance the portfolio when things drift. And here's an example of that. In that same scenario, again, this is just made up, but if stocks do go up and take a bigger piece of the pie, then the simple thing to do is sell stocks to balance out the portfolio to get back to that original pie that you agreed on. And then say that stocks go down some year, and then they end up taking a smaller portion of the pie, then it's time to sell some of the bonds and buy some stocks to get back to that original 60-40 mix. Now again, that's just an example of what this strategy of asset allocation could look like. Now the second thing to do this year is make sure you have enough money in your emergency fund. Looking back at 2020, we saw that those who had a healthy amount of cash or conservative investments were able to weather the storm much easier than those who did not have emergency funds set aside. Now the right amount to keep in your emergency fund is going to vary depending on your personal preferences, and a common answer that you'll see is that maybe have between 3 to 6 months of expenses set aside. But if you're in retirement or getting close to retirement, then you might want to think about having more in the conservative bucket. If you want to get an idea of the amounts to have in conservative funds, I'll put a link in the description below to the 3-bucket withdrawal strategy so you can have an idea of what that strategy is and how people allocate into these different buckets. This year has been a challenging one for sure, and nobody really knows what's going to happen in the next year. But hopefully these 2 investing moves can help you get on track for a brighter financial future. If you like this video, then subscribe so that you don't miss the next one, and then I'll see you there.